I will now prepare our free cash flow valuation model for Tesscow Limited. In this presentation, I provide a brief overview of the spreadsheet and the different worksheets within it. Bear in mind, we are building a very simple model for explanatory purposes. In practice, the model and the process would be more sophisticated. The valuation process flows through the different worksheets from left to right. As we progress through the worksheets, we progress through the valuation exercise. The first worksheet, the Raw Historical Data tab, contains raw historical data on the company. This is mainly comprised of its historical financial statements, but you can include other data here too, such as footnotes or external reports. You could retrieve this data manually, or you could retrieve it from a financial database, such as Bloomberg, Compustat, DataStream, or FAME. Once we've collected the historical financial statements for the company, say for the past 10 years, the next step is to prepare integrated financial statements. You should notice the historical financial statements include many line items. We don't need this level of detail for the purposes of valuation. The next step involves amalgamating and condensing the line items in the historical financial statements into a reduced select number of line items in the integrated financial statements. We only need a select few line items to perform the valuation. At the end of this step, you should have prepared a condensed integrated income statement for each historical year, and you also should have prepared a condensed integrated balance sheet for each historical year. Within the Integrated Financial Statements tab, we perform a second important function. Within this worksheet, we project or forecast the financial statements over the forecast period. These colored columns represent the future forecast period for Tesscow. Remember, I selected a 10-year forecast period, which was comprised of a 5-year detailed forecast period, followed by a further 5-year simplified forecast period. After the 10-year forecast period has lapsed, I assume Tesscow reaches a steady state. Once a company has reached a steady state, I can use a perpetuity to calculate the continuing value component for the company. The CV column, or continuing value column, represents the financials for the company once it has reached a steady state. I will use the figures within this column as the base figures for the perpetuity calculation. So how do we project the financial statements into the future? How do we forecast the financial statements over the horizon period? We will use the next tab, the Historical Analysis and Forecast Ratios tab, to do this. In order to project the financial statements into the future, over the forecast period, we have to think about what drives each one of the line items in the integrated financial statements. We have to consider what factor causes each line item to change. Once we've determined a driver for each line item, we should then calculate historical ratios for the line items based on that driver. We can use the historical ratios as an input to predict the forecast ratios over the future period. We then use those forecast ratios in order to project or forecast the financial statements over the forecast period. The next worksheet, the Market Data and WACC Calculation tab, is where we should collect all of the market data that we need for the company. This worksheet will also contain our calculation of the company's weighted average cost of capital, its WACC. This will comprise of a calculation of the company's cost of equity, perhaps using the capital asset pricing model, and also a calculation of the company's cost of debt. We then amalgamate these two components in a calculation of the company's WACC. These calculations are beyond the scope of this presentation, so I've simply pulled the WACC and the cost of equity for the past financial year for Tesscow from a financial database. Within the Reorganized Financial Statements tab, we extract the components that we need in order to calculate free cash flow for each year over the forecast period. At this stage, we would have forecast the financial statements over the forecast period. We would have done this in the Integrated Financial Statements tab. In the Reorganized Financial Statements tab, we use those forecast integrated financial statements to extract the components that we need to derive our measures of free cash flow. So we extract NOPAT, after-tax interest expense, net income, the change in working capital, the change in long-term assets, and the change in net debt. These are all components that we will use to calculate free cash flow. In the ROIC and free cash flow tab, we will neatly arrange the components that we've just derived in the Reorganized Financial Statements tab. So we will take the NOPAT, net income, and the other components of free cash flow, and we will lay them out neatly to derive free cash flow to the firm and free cash flow to equity. So we take NOPAT, less CapEx, less change in working capital to derive our measure of free cash flow to the firm. From free cash flow to the firm, we take away interest expense after tax, and we add the increase in net debt to derive our measures of free cash flow to equity over the forecast period. On this worksheet, we should also calculate the implicit return on invested capital for each forecast year. We do this as a reasonableness check. We need to check that the financial statements that we forecast over the forecast period are reasonable. In addition, we need to check that the forecast ratios that we've assumed that underlie the integrated financial statements make sense. We do this by calculating the implicit return on invested capital for each year over the forecast period. We expect to see one of three general trends in the return on invested capital over the forecast period. The ROIC should remain near current levels, or it should trend towards the industry or economic median, or it should trend towards the company's cost of capital, unless the company has a long-term competitive advantage. Now that we've calculated the free cash flows for Tesscow over the forecast period, we can use those free cash flows to value the firm. The last worksheet, the Valuation Summary tab, is where we complete the valuation exercise. Let's consider the free cash flow to the firm valuation model first. Remember, this model outputs a value for the entire firm or enterprise, including both debt and equity components. We begin by inserting our estimates of the free cash flows to the firm. We get these estimates from the previous worksheet where we've compiled them. After we insert our estimates of the free cash flows, we complete the valuation process in two parts. In the first part, we discount back the free cash flows to the firm over the 10-year forecast period using an appropriate discount rate. Next, we calculate the continuing value component using a perpetuity. Let's consider the first part. In the first part, we discount back the free cash flows to the firm using an appropriate discount rate, which is the WACC. This will allow us to arrive at the present values for the free cash flows to the firm over the 10-year forecast period. Next, we turn to the calculation of the continuing value component. We calculate the continuing value component using a perpetuity. I have selected a simple growth perpetuity to calculate the continuing value component for Tesscow. This perpetuity equation takes three parameters. It takes a base cash flow, which will be the free cash flow to the firm in year 11. It takes a growth rate and the WACC. When we input these three values into the perpetuity equation, we will arrive at a continuing value for Tesscow. We then have to discount back this continuing value to the beginning of the forecast period, or to the valuation date. This will allow us to arrive at the present value for the continuing value component. Finally, we add the present values of the free cash flows to the firm over the 10-year forecast period to the present value of the continuing value component to arrive at an overall value for the company. Now, let's consider the free cash flow to equity model. Remember, this model outputs a value for the equity component of the company only. The mechanics behind this model are identical to the mechanics behind the model we just discussed. We begin by inserting our estimates of the free cash flows to equity. We get these estimates from the previous worksheet where we have compiled them. After we insert our estimates of the free cash flows, we complete the valuation process in two parts. In the first part, we discount back the free cash flows to equity using the cost of equity, which is the appropriate discount rate. This will allow us to arrive at the present values for the free cash flows to equity over the 10-year forecast period. Next, we will turn to our calculation of the continuing value component. Again, I will use a simple growth perpetuity equation to calculate the continuing value component for Tesscow. It takes three parameters: a base cash flow, in this case we will use the free cash flow to equity in year 11, a growth rate, and the cost of equity. When we input those three values into the perpetuity equation, we will arrive at a continuing value for Tesscow. We then have to discount back that continuing value to the beginning of the forecast period, or to the valuation date, to arrive at the present value for the continuing value component. Finally, we add the present values of the free cash flows to equity over the 10-year forecast period to the present value of the continuing value component to arrive at a value for the total equity of Tesscow. I read up on the company and I found out that the company had 8,140 million shares outstanding at the valuation date. In addition, at the valuation date, Tesscow's shares were trading at a price of £1.88 per share. If we take the equity value derived using our model for Tesscow and divide it by the number of shares outstanding, this will allow us to calculate an estimate of the price per share per our valuation model. We can then compare this with the price per share on the market for Tesscow on the valuation date.